Financial statement analysis extends beyond the calculation of accounting ratios and requires a comprehensive interpretation of both financial and non-financial information. Stakeholders seek to understand not only an entity's historical profitability but also its liquidity, solvency, cash-generating ability, sustainability, and long-term value creation potential. Consequently, effective analysis requires the integration of information contained in the statement of financial position, statement of profit or loss, statement of cash flows, and accompanying disclosures together with broader economic, strategic, and environmental information. Such integrated analysis enables users to assess corporate performance from multiple perspectives and supports informed economic decision-making. Interpretation of financial statements for different stakeholders. Different stakeholder groups have distinct information needs and therefore interpret financial statements differently. Investors and shareholders focus primarily on profitability, earnings growth, return on equity, earnings per share, dividend capacity, and future cash flows. They seek evidence that management is generating sustainable returns capable of increasing shareholder wealth. Lenders and banks emphasize liquidity, gearing, interest cover, and operating cash flows to evaluate the entity's ability to repay borrowings and meet financial obligations. Strong profitability alone may not satisfy lenders if cash generation remains weak. Suppliers and trade creditors are primarily concerned with short-term liquidity and working capital management because these factors determine the entity's ability to settle trade payables on time. Employees may evaluate financial stability, profitability, and future growth prospects when assessing job security, wage negotiations, and pension obligations. Governments and regulators analyze financial statements to ensure tax compliance, monitor corporate governance, and evaluate the entity's contribution to economic development and employment. Management itself uses financial analysis to assess operational efficiency, identify weaknesses, formulate strategy, and improve future performance. Consequently, identical financial statements may generate different conclusions depending upon the objectives of individual users. Interpretation of the statement of cash flows. The statement of cash flows provides information unavailable from the statement of profit or loss because it explains actual cash generation and utilization during the reporting period. Positive operating cash flows indicate that core business operations generate sufficient cash to sustain ongoing activities, repay borrowings, invest in future growth, and distribute dividends. Strong accounting profits accompanied by weak operating cash flows may indicate aggressive revenue recognition, deteriorating receivable collection, or poor working capital management. Investing activities reveal management's long-term strategic decisions regarding capital expenditure, acquisitions, disposals, and investment expansion. Substantial investment outflows may reduce current liquidity but indicate confidence in future growth opportunities. Financing activities explain how operations and investments are financed through equity issues, borrowings, debt repayments, or dividend distributions. Together, profit and cash flow information provide a more complete assessment of financial performance than either statement individually. Integrating financial and non-financial information. Modern financial analysis increasingly requires integration of financial statements with non-financial information to evaluate long-term performance and enterprise value. Financial ratios alone cannot explain changes in customer satisfaction, innovation capacity, employee productivity, environmental performance, or competitive positioning. Relevant non-financial information may include market share developments, customer retention rates, employee turnover and workforce skills, product quality indicators, research and development activity, digital transformation initiatives, environmental performance, corporate governance practices, sustainability risks and opportunities. Combining financial and non-financial information provides a broader understanding of management effectiveness and future business prospects. For example, declining short-term profitability may be acceptable if accompanied by increased investment in innovation and expansion that supports long-term competitive advantage. Current value versus historical cost. The measurement basis adopted within financial statements significantly influences financial analysis. Historical cost accounting records assets and liabilities at original transaction values, adjusted for depreciation or impairment where appropriate. Its principal advantages include objectivity, verifiability, and consistency because values are supported by actual transactions. However, historical cost may become increasingly outdated during periods of inflation or rapidly changing market conditions. Long-held assets may possess market values significantly different from carrying amounts, reducing the relevance of financial ratios based upon book values. By contrast, current value accounting, including fair value measurement, reflects contemporary market conditions and current economic value. Current values improve relevance by presenting assets and liabilities closer to their actual economic worth and providing users with more realistic assessments of financial position. Nevertheless, fair value accounting often requires estimation techniques and valuation models where active markets do not exist, introducing subjectivity and greater earnings volatility. Consequently, profitability and return ratios calculated using current values may differ substantially from those based on historical cost. Modern IFRS therefore adopts a mixed measurement model, balancing reliability with relevance by applying historical cost to many operational assets while using fair value where current market information provides superior decision usefulness. Other relevant information for performance assessment. Financial statements alone cannot capture every factor influencing organizational performance and financial position. Users increasingly consider external economic information, including inflation, interest rates, exchange rates, industry growth, competitive pressures, government regulation, and technological developments. Similarly, environmental, social and governance (ESG) factors have become increasingly important in assessing long-term sustainability and enterprise value. Examples include carbon emissions and climate-related risks, energy efficiency, diversity and inclusion policies, human capital development, supply chain resilience, corporate ethics and governance quality, cybersecurity and data protection, management commentary, integrated reporting, sustainability disclosures, analyst reports, and strategic business plans may therefore provide valuable supplementary information beyond traditional financial statements. Financial reporting significance. Effective financial statement interpretation requires much more than ratio calculation. Investors and other stakeholders must analyze profitability, liquidity, solvency, efficiency, and cash flow information while incorporating broader financial and non-financial factors that influence future performance. The statement of cash flows complements accrual accounting by revealing actual cash generation, while sustainability information and strategic disclosures provide insight into long-term resilience and value creation. Furthermore, understanding the impact of historical cost and current value measurement enhances the quality of financial interpretation by recognizing the strengths and limitations of different accounting bases. Through integrated analysis of financial statements together with economic, operational, and sustainability information, stakeholders can make more informed assessments of an entity's performance, financial position, and long-term prospects.